bond market is a market that is not followed by the general public. When you listen to the news, financial news or any news, especially, well, at least here in the UK, they say, the stock market did this and the currency did this, but they never talk about bond yields or anything. So, and what the Treasury is doing is something very technical. So that won't even see the light of day in the mainstream news for the general public. So what they're doing is they are issuing more short-term debt so that there's not that much pressure on the longer-term interest rates. So they're doing actually what Janet Yellen was doing, and they were critical of Janet Yellen. The other thing they're doing, I saw that they can buy back like existing debt, long-term debt. When they issue short-term debt and they get the cash, they can go in and buy 5 and 10 years debt. And I think they're doing that. Actually, they announced it a couple of weeks ago, the Treasury. So that's how they do it, because right now the Federal Reserve is still doing quantitative tightening. They're still selling their treasuries or letting them roll off without adding them back on. So yeah, they can do it, and they can kind of do a yield curve control, which is usually the something the central bank does. So the other thing with a possible revaluation, let's say if they revalue to a level where they got, let's say, around 6 trillion or maybe a little less, they could actually go to the Federal Reserve and buy all their almost all their assets, because the Fed's balance sheet is like just under 7 trillion. That they could go and buy 6 trillion worth of it and retire all that debt, treasury debt and mortgage debt, and then the Fed's balance sheet would go back down to like 800 billion, which was where it was before the '08 crisis, and then they can start inflating the credit system again. Maybe that will happen once we get that 1-to-1 Dow Gold ratio. That would make sense, because from then they can start again. It's going to be another 30, 40 years maybe of boom. But before that, it's going to be painful. And it's already painful, I think, for the majority of people. It's only the people at the top and the very wealthy that are benefiting right now, because asset prices are going up and they have a lot of assets.
So how would it actually differ from this yield curve control compared to the QE playbook? And why might it actually be harder to unwind this time?
Yeah, a QE is just the central bank going into the secondary government bond market and buying bonds. They don't go straight to the auction when the Treasury sell bonds, because it would look too Weimarish. I mean, buying debt directly from the Treasury. So they allow the primary dealers, mainly the Wall Street banks, to buy at the auction, and they go in and buy the bonds. Yield curve control is more of not a threat, but an announcement to the markets that, for example, the Fed will not allow the 10-year yield to go above 4.5%. And if the market tests that level, the Fed will come and do QE to bring that yield back down to that level by buying the 10-year yield. That's the difference between QE and yield curve control. But they've been doing a mixture of both, I guess. In Japan, they're still doing QE. Yeah, I mean, Japan, people were always talking about the danger of deflation. And by deflation, they meant prices, the CPI shrinking, right? Not growing. And I always thought that was strange, because if the CPI is going down slightly, that's actually good for consumers. So they were adamant, and they're still adamant in Japan, to keep CPI and prices rising. They think that it's the Keynesian mentality, that they think that will keep the economy going. But what we see now in Japan is that people are feeling the pinch. And even there, the politics is changing, and people are angry. And their CPI is like 3 or 4% now. It's probably higher, because they always tinker with the number. And that's why their bonds are going down so so sharply, especially the longer term bonds, and their yields are going up. So, and the gold price in Japanese yen, it's done better than in all other currencies. And I think they're going to try the same in the U.S. And it's going to fail. All it's going to do, it's going to debase the currency even more. It's going to raise the cost of living even more. I mean, we see President Trump calling for rate cuts, even though everything's booming in terms of financial indicators. In the UK, I think it's a little different because the Japanese are big savers, and they have a lot of, even though the government has a lot of debt, 230% of GDP. They're big savers, and it's an aging society. But here in the UK, we're not that big a saving nation, and we have a lot of foreigners buying our gilts. So I think we might have a tougher time doing it than Japan or the US. We might be in the same boat as Portugal, Italy, Ireland, Greece, and Spain back in 2011, 2012, where we see people just dump the government bond of the UK, and yields will spike. And we're having problem now because we're not like a major reserve currency, and we can't just cut rates and do loads of QE to keep rates down. It would really impact our currency.
You know, one of the strangest things about the financial world is how lopsided the coverage is. Turn on the BBC or Bloomberg or even CNBC, and what do you hear? The stock market's up today, the pound is down, oil is steady. But how often do you hear them talk about the bond market? Almost never. And yet the bond market is the foundation of everything. Stocks are the froth, bonds are the plumbing. If you ignore the plumbing long enough, well, let's just say eventually you'll smell it. The average person doesn't follow bond yields. Why would they? It's technical, it's boring. It doesn't make for sexy headlines. But behind the scenes, the Treasury and the Fed are playing with the dials on that system every single day. They're issuing short-term debt, buying back long-term debt, doing little swaps here and there, all designed to keep the long end of the yield curve from blowing up. In the UK, the situation is similar. The Bank of England talks a good game about fighting inflation, but the real story is always the same. How do they keep the bond market from revolting? Now let's break this down simply. Quantitative easing, QE, is where the central bank goes into the secondary bond market and buys government debt. They don't go directly to the auction because that would be too naked, too obviously monetizing government spending. So they let the primary dealers, mostly Wall Street banks, buy at auction, and then the Fed comes in through the back door and buys from them. It's a charade, but it works until it doesn't. Yield curve control, on the other hand, is more explicit. It's the central bank basically saying, look, the 10-year yield is not going above 4.5%. Don't even think about it. If you test us, we'll just print money and buy every bond in sight to force it back down. That's what Japan has been doing. They call it YCC, yield curve control. And they've been at it so long that their bond market has become a zombie. No one trusts the pricing because it's no longer a market. It's just the Bank of Japan dictating levels. The US isn't quite there yet, but they're inching toward it. Janet Yellen has been issuing more and more short-term debt, bills instead of long bonds, precisely to avoid putting pressure on the 10-year and 30-year maturities. And guess what? They've even started buying back long-term debt using the proceeds from issuing short-term bills. It's a sleight of hand. The Fed is still supposedly doing quantitative tightening, letting bonds roll off the balance sheet, but the Treasury has its own little playbook, its own version of YCC. They're propping up the long end even as the Fed pretends to be tightening. Now here's where it gets interesting. Imagine they revalue gold. And we've talked about this before. If the Treasury revalued gold high enough, say to the level Jim Rickards has suggested, $24,000 an ounce, then the Treasury General account would suddenly be flush with trillions in new firepower. For every $4,000 increase in the official gold price, the Treasury gets about $1 trillion in balance sheet room. At $24,000, they'd have roughly $6 trillion. That's enough to go to the Fed, buy back nearly all of its assets, and reset the Fed's balance sheet to pre-2008 levels, around $800 billion. Imagine that. Wipe away the mountain of treasuries and mortgage-backed securities sitting on the Fed's books and start the credit cycle anew. Of course, before that reset, there's going to be pain. A lot of pain. It's already painful for the majority of people. Asset prices are inflated, but only the top percentiles really benefit from that. The average household is squeezed by higher food, higher energy, higher rent. Meanwhile, Bezos and Zuckerberg are dumping stock. Warren Buffett is sitting on $500 billion in cash. Insiders are leaving the equity markets while the public is piling in at the top. Doesn't that remind you of 1999 or 2007? The insiders sell to the outsiders. That's how every cycle ends. And here in the UK, we have our own challenges. We're not a major reserve currency like the US. We don't have the luxury of endless QE without consequences. When we tried that trick under Liz Truss, remember what happened? Gilt yields spiked, pension funds nearly collapsed, and the Bank of England had to step in with emergency buying. That was a warning shot. We don't have the deep global bid that the US Treasury enjoys. We're closer to Italy or Greece in that regard. If markets lose confidence, yields can spike very fast, and we can't print our way out without destroying the pound.
I mean, yeah, the U.S. Treasury officially has 8,133 metric tons of gold, and the Federal Reserve has gold certificates that are claimed to that gold. And the reason that happened was back in '33 when Roosevelt, when he took in all the gold, he made gold illegal, and people had to hand in their gold and take Federal Reserve notes for it. All the gold came through the Fed regional banks, and then the Fed regional banks gave the gold to the Treasury, and the Treasury issued these gold certificates, and that was at $20.67, and then in 1934 they came out with the Gold Reserve Act in January 30th, I think, 1934, and that day they revalued gold to $35, and the Fed sent the profit to the Treasury because the gold was taken in at $20.67, and the revaluation, they sent the profit to the account of the Treasury, and they kept those certificates. And then in 1972, after Nixon closed the gold window, the Congress revalued that price from 35 to 38 because, the international price of gold was going up, and it didn't make sense to have the price at 35. They revalued it again in 73 at 42.22. And by then, gold was almost at 100. So they're always late, but they haven't revalued it since then. So all that gold and the certificates at the Federal Reserve are worth about $11 billion. So if they revalued the gold certificates to, let's say, $3,400, that would be about $800 billion in profit for the Treasury, and they would have to write new certificates for the Fed at $3,400, and the Fed would send the profit to the Treasury, and they could use that to do whatever they want to. So if you revalue it to 15,000, I mean, that's a much bigger number. I think Clive came up, I don't know how much it was. So that's about four times. So it's about 4 trillion. If you do it to 30,000, that's 8 trillion. So they could choose any number. But the thing is about revaluing, and we saw the other day, Alexei, that even the Federal Reserve Board now, on August 1st, they published an article about how this process works, and they'd never done that before. So are they preparing to do a revaluation? I don't know, it's just speculation, but if they revalued it to the market price right now, let's say 3,400, yes, they'd have an extra 800 billion, the Treasury. That would help them. But what it would do, it would put a floor under the gold price, because back in 73, when they revalued it to 42.22, we never saw that price again.
You see, the real danger isn't QE anymore. Everyone knows what QE is. It's old hat. You print reserves, you buy government bonds, you suppress yields, and you hope nobody notices the hidden inflation tax. But yield curve control is a different animal. It's more brazen, it's more desperate. It's essentially the central bank saying, "We're the market. Don't bother fighting us." And that's when you know the game is almost up. Because the moment you have to declare yourself the market's already lost faith. Think about it. In Japan, they've been doing YCC for years. And what's the result? The yen has collapsed. Japanese households are poor. The price of gold in yen has gone parabolic. You can keep the bond yield pinned where you like, but the pressure pops out somewhere else. And that somewhere else is always the currency. Now imagine the US trying the same trick. They're already halfway there. Yellen is stuffing the front end of the curve with short-term bills. That's manageable because money market funds are happy to buy short paper. But what about the $28 trillion in maturing treasuries over the next 3 years? Where's the demand going to come from? China's selling, Japan's selling. Saudi Arabia isn't interested. Even the UK, supposedly our special relationship partner, is up to its neck in debt. So who's left? The Cayman Islands? Ireland? These are just conduits, not genuine demand. It's a shell game. This is where the gold revaluation comes in. Judy Shelton has been talking about it openly. Jim Rickards has modeled it. And even the Fed itself has published papers on gold revaluation accounts. It's not a fringe theory anymore. It's being discussed in mainstream institutions. Why? Because they know they're trapped. You cannot pay down $37 trillion in US debt with $15 trillion in tax revenue over 3 years. The math doesn't work. The only way out is to inflate it away. But instead of hyperinflating, which destroys everything overnight, you can do a soft default by revaluing gold. Let's run the math again. For every $4,000 increase in the official gold price, the Treasury gets $1 trillion free and clear through the gold revaluation account. Take gold to 24,000 and you've got $6 trillion. Suddenly you can retire a huge chunk of debt, reset the Fed's balance sheet, and claim victory. Of course, the dollar gets devalued by 60% in the process, but they'll spin that as necessary for competitiveness. Trump will say, "We need to bring manufacturing back. We need a weak dollar to export again." And he'll be right in a way, but it won't be painless. For ordinary savers, it will be catastrophic. Your dollars will buy half as much. This is why owning physical gold and silver isn't just about investment. It's about survival. If you're sitting on cash when they pull the lever, you've just been robbed in broad daylight. If you're sitting on real money, your purchasing power is preserved, maybe even multiplied. And here's where the BRICS come in. While the West fiddles with QE and YCC, the East is building a new system altogether. The Shanghai Metals Exchange is expanding. Russia is setting up a St. Petersburg exchange for gold. China is building multi-jurisdictional vaults in Hong Kong, Saudi Arabia, Dubai, and Moscow. They're connecting their M-Bridge payment system to ASEAN, to the Middle East, to the Belt and Road Initiative. That's 75% of the world's population, and they're settling trade imbalances in gold outside of SWIFT, outside of Western sanctions. Sergei Lavrov said it himself. This technology settles in 7 seconds, with a 98% reduction in fees, and it is not compatible with the dollar, the pound, or the euro. Think about that. 90% of humanity trading outside the Western system using gold as the ultimate settlement asset. Meanwhile, the BBC is still telling you the FTSE is up 0.5% today. Who's more in touch with reality? Here in the UK, we're especially vulnerable. We're not the US. We don't have the exorbitant privilege of issuing the world's reserve currency. We can't flood the world with pounds and expect everyone to hold them. Our trade balance is negative. Our government debt is massive, and our savings culture is weak. We don't have the domestic cushion Japan enjoys. If foreign investors dump gilts, yields will spike and the pound will collapse simultaneously. It'll be like 1976 all over again, when Britain had to go cap in hand to the IMF. Only this time, the IMF itself is a weaker institution, and the BRICS alternatives are stronger. So when people ask me, "Mario, what's the endgame?" I tell them, the endgame is a return to gold. Not because governments want it, but because reality demands it. You can only play with paper for so long before the paper burns. Credit must be tied to corporeal money, money that actually exists, with no counterparty risk. That's gold. Always has been, always will be. Now let's be clear. They won't go straight to a classical gold standard overnight. They'll try halfway measures first. They'll issue stablecoins backed by treasuries. They'll experiment with central bank digital currencies. They'll tinker with gold revaluation accounts. They'll call it modernization or innovation. But underneath the jargon, it's just an admission that fiat is failing. And don't think for a second that politicians won't be tempted to confiscate. Roosevelt did it in 1933. Could it happen again? Of course it could. Politicians aren't driven by common sense. They're driven by envy and expedience. If they see some people getting rich off gold while everyone else suffers, they'll want a piece of it. If that happens, gold and silver will go bid only. No offer. You won't be able to get it except on the black market, and the price will skyrocket, which is why you must own it long before that day arrives. There's another dimension to all this that almost no one talks about: derivatives. Since the 1980s, we've built an empire of paper claims on everything: commodities, metals, energy. It worked fine when the West dominated demand, but now demand is coming from Asia. China has been using our price suppression to build massive inventories. She's been buying silver, copper, gold, platinum, palladium, all at artificially low prices thanks to our derivatives. And now she's holding on to it. No more feeding it back into the market to stabilize prices. Why would she? The fiat system is ending. She wants the real stuff. That means liquidity in the derivatives markets is drying up. And when liquidity dries up, the paper game breaks. So where does this leave us? In my view, we're at the death throes of the fiat era. The credit bubble is the largest in history. Margin debt in the US is over $1 trillion. The NASDAQ has gone up 19-fold since 2009. The S&P 10-fold. Insiders are selling. Institutions are selling. The public is all in. And on the other side, central banks are buying gold at record pace. That tells you everything you need to know. The transition won't be smooth. There will be crashes, panics, confiscations, propaganda campaigns. They'll call gold a barbarous relic one week and then quietly revalue it the next. They'll try to distract you with elections, with tariffs, with wars. But behind the noise, the reset is already in motion. So what should you do? Stay out of the herd. Don't chase momentum stocks at all-time highs while insiders dump. Don't trust bonds in a currency system that's collapsing. Accumulate real money. Hold it outside the system. Because when the dust settles, those who hold corporeal money will be the foundation of the new system. And those who don't, well, history is clear about what happens to them. As Richard Russell used to say, inflate or default. That was 20 years ago. Today, the choice is the same, only the stakes are higher. They'll choose to inflate, they'll choose to devalue, and they'll call it patriotism or progress or whatever label makes the medicine go down. But if you see it for what it is and prepare accordingly, you won't just survive. You might actually thrive.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.